Hello, you're watching Smart Money, and today we're catching up with Trinisha Chanka, sales manager at 91, as the firm marks a milestone entering the actively managed ETF market with the listing of two actively managed exchange traded funds, or AMETFs, on the JSE. Trinisha, thanks so much for joining us today, and I'm going to launch straight into it, right at the top. Why enter the ETF space now? And more specifically, why take the actively managed route instead of the traditional passive one?
Thank you, Alicia. Look, it's lovely to be here. This is definitely a milestone moment for our business, and we are very excited to be bringing 35 years of active investment expertise to the JSE. The main reason we have embarked on this journey is, we want to meet our investors where they are. So as investors continuously demand increased efficiencies through intraday trading and liquidity and access that the JSE can provide, we want to meet the investors on the JSE. The products that have been on the JSE have historically been passive, but the recent changes have made it possible to now launch actively managed ETFs on the JSE. And so the environment is ripe for innovation and ripe for investors to benefit from our ability to outperform the indices.
Yeah, I want to home in on that environment because we've seen the global ETF market evolving rapidly, right? With actively managed ETFs gaining this momentum that you're talking about. What trends are driving this growth internationally? And how does that compare with what we're seeing in South Africa right now?
So internationally, the global ETF industry has become a $17 trillion industry, and it's expected to grow in double-digit figures from here over the next 5 years, getting to about $25 trillion. The same is true for South Africa. We've seen the ETF market, which is not new to South Africa. ETFs have been around in the South African market for about 25 years. But, the fastest growing segments in this market have come in the last 2 years, where we've seen a significant increase in the number of actively managed products that have listed on the JSE and globally. In fact, nearly half of all new ETF launches last year were in active managed strategies. So this is definitely a trend that is happening both globally and in South Africa. It is not a US specific trend. Europe is growing steadily, Asia Pacific region is growing steadily, and so is South Africa.
Yeah. From that local perspective, Tanisha, what's changing in South Africa's investment landscape or the market that's actually supporting this kind of innovation and evolution that we're seeing?
So I think the first and foremost, the recent changes in the JSE listing requirements almost 2 years ago have now made it possible to list actively managed products on the JSE. In the past, that wasn't a possibility. So that regulatory change has obviously driven a lot of the innovation. But globally, where we're seeing fast-growing segments of the ETF market, the ETFs are no longer seen as niche products. They're very much part of the norm these days. They're a cornerstone to most investment portfolios. And we think what's driving that is, on the one hand, it's partly due to younger digital savvy investors who want to invest immediately. They want to invest within minutes on their smartphones, given the lifestyles that they've become used to. They're used to buying online. That's the norm now. If we think about our South African context, Checker 6060 is very much part of our everyday lives. I'm an avid shopper of Shein, Take-A-Lot, etc. And so, it's as much about the ease of access that you can get from buying something on an exchange, as well as the lower minimums that apply to the ETFs. But I think predominantly it's about consumer experience. And just like you're able to track your Uber Eats delivery as it walks through the process, or your Take-A-Lot delivery, when you buy on exchange, you're now able to buy your investments and bring that investment experience online and track your journey in real time.
Okay, got it. So let's talk about the two AMETFs that you're listing, right? And I know I'm going to front load a lot of the questions here, but walk us through what they are, how they work, and why you've chosen these specific strategies.
Perfect. I mean, that's the question I've been waiting for the whole interview. So I'm very happy to talk about that. But we are listing two income actively managed ETFs on the 12th of November. The first one is a local income multi asset solution. This is a Regulation 28 compliant portfolio, and its key objectives are to generate income, and it's got a very strong capital preservation bias. Now, it's perfect for anybody that is sitting on cash, who's either kind of got excess cash and wants to sweat that a bit, sweat that a bit, earn higher returns, but still have the safety or the peace of mind of preserving the capital. A lot of investors have been, worried about the markets and might be sitting on the sidelines wanting to re-enter. In South Africa, we've got a huge amount of money that is sitting in retail bank deposits. If you look at the South African Reserve Bank statistics, they estimate there's almost 450 billion rand sitting in household deposits at the banks, in deposits of a month or more. This is the perfect strategy for those deposits because instead of earning, a cash return of around 6%, you can now earn about, close to 9% yield in our diversified income actively managed ETF. It is diversified across a number of asset classes. So we give you exposure to a bit of cash, some bonds, a little bit of property, and some offshore bonds. That historically was not available on the JSE. So in the past, if you want to buy anything fixed income related on the JSE, your only options were usually buying what we call a government bond index ETF. So you had access to the full suite of bonds available by the government, but as a result, that was quite a volatile investment. You could lose capital in that instance. So this is providing a solution to a need, well, where we want to switch your cash in a vehicle or product which you wouldn't historically have had access to on the JSE. So that's the first one. The second one is similar, but it is a global income fund. So it gives you access to global bonds from developed and emerging markets. We manage the exposures to cash and bonds. Our objective there is to outperform US dollar cash. So think of, South Africans have historically, taken money offshore. Sometimes that money is sitting in a US dollar retail deposit. They're earning, 2.5%. You can now earn 5% in dollars in this fund. You get access to a long track record. We've been doing, we've been managing these types of investment strategies for many, many years within our unit trust business. Our portfolio managers have substantial experience. And I think what you benefit from is that, these actively managed ETFs are not new strategies. So investors buying them are really going to be entering into a scalable investment strategy that's got a demonstrable track record and has got 70 plus investment global professionals within the fixed income space backing these investment decisions.
Yeah. And what we've established up to this point is that both funds are structured as these feeder funds, right? So they invest into 91's existing structures, giving investors, you know, access to your established actively managed fund strategy. So I want to unpack that a bit further. I mean, what does that mean in terms of cost effectiveness and investor benefit, especially when compared to a typical passive ETF that simply tracks an index?
So, Alicia, thank you for that question. I think you've hit the nail on the head. These actively managed ETFs are going to feed into investment strategies that are already at scale. So, for our diversified income actively managed ETF, we already manage 30 billion Rand in that exact same strategy. We've got a 15-year track record in that space. You can look at historically how that strategy has performed, and we can tell you that it's currently yielding about 8.5% after fees. Um, Similarly, on the global side, for our global diversified income actively managed ETF, it is feeding into our $400 million offshore fund. That fund's been not been running for as long, but it's, you can see the performance of that fund to give you a sense of what you might expect going forward in the ETF. From a cost perspective, the management fees that apply to the ETFs are identical to the management fees that apply to our unit trusts. So, as a result, we want to leave the decision in the investor's hands based on, the features of whether they like the efficiencies of the ETF or whether they prefer, the unit trust, which they are familiar with. That decision is then ultimately up to the investor because they're getting the exact same investment strategy at the exact same fees across both product vehicles. From a cost perspective, just with respect to the passives, like I said, historically on the JSE for these specific type of income solutions, you haven't been able to access income solutions in a passive format because by its very nature, it requires active management. It requires a manager to dynamically allocate across these multiple asset classes of bonds, cash, offshore bonds, emerging market bonds, FX, etc. And by definition, a passive investment tracks an index. So there hasn't been an index that's straddled that multi-asset capability. And so, from a comparative perspective, there aren't really comparative income products. But I think your question is probably geared towards, in general, how do the fees stack up between active and passive? The fees on the passive counterparts, if you think about like an equity or a global equity offering, which is something that we will look to list in future. So the question is very valid. Typically passive instruments tend to be cheaper. You do pay more for your active components. I would encourage investors to not simply focus on the cost of the annual fees, but rather focus on the value that you get from the active management, benefits. In today's markets, where uncertainty is higher than ever, with the likes of the stop-start tariffs or geopolitics, etc., I think having an active manager by your side can really help you navigate those types of shifting markets. And as we all know, for example, in like a global equity portfolio, if you're invested in a passive index tracking portfolio, you've got huge concentration. So you currently have the top 10 holdings of the S&P are almost 40% of the market. And so you are overexposed to a single region, being the US. You are overexposed to, probably singular sectors like AI, and obviously you're overexposed to single sectors. As an active manager, we can, hopefully avoid overpriced stocks. We can focus on quality businesses. We can right size your positions to really ensure that you end up with a robust, diversified, risk managed portfolio. And so I think now more than ever, active management is what you need, someone to partner with you as you walk this very uncertain investment journey.
Absolutely. Well, Trinisha, thanks so much for walking through this with us. It's a fascinating time for South Africa's ETF market, and it certainly is going to be interesting to see how investors respond to, let's call it, the next phase, right? Trinisha Chanka is sales manager at 91, and that's where we leave it for now. Thanks so much for watching Smart Money.